Welcome to this month's webinar, Sector Rotation, Does It Work? Let's explore. My name is Robert Peelman. I'm the Director of Investment Planning here at OJM. This is this is the second part of our two-part series on technical analysis. The first webinar was titled, How Technical Analysis Can Add Value to Your Portfolio. The hope today is you have a clearer understanding of not only why we do the strategy and add it to a client's portfolio, which you found out in the first webinar, but a little bit of how it's performed, some of the statistics, what you can expect, and a little bit more detail on the portfolio rules as we go. So we'll start out today, obviously, with some disclaimers that we put into our presentations to describe a little bit about the fact that we're an SEC registered investment advisor doing business here in the state of Ohio. Some of our material that you can pick up as a participant here in the webinar, free to all attendees. We have copies of For Doctors Only. We've written several publications and hope that you'll reach out to us and if you have not already, pick up one of the publications that we have to offer. So topics for today: who is OJM? Understanding some rules of the portfolio and what to expect. Relative strength, so the actual principle behind how we build out this portion of your portfolio, and then some detail on some of the overall statistics as we go. So who is OJM? We're a comprehensive financial planning firm, multidisciplinary. We've got professionals in a variety of areas and disciplines that are experts. We have MBAs, CFPs, CPAs, offering everything from investment management to education, college planning, tax advisory services, asset protection planning, and of course insurance and some legal planning as well. So our hope is as clients work with us, is they find that what we do from a comprehensive standpoint is something that they can't get elsewhere, where they begin to try to piece that together. A portfolio that is managed by OJM Group, we take an institutional investment approach, which is tailored to the individual needs of clients. Essentially, what that means is, most retail clients can expect typically just some mutual funds or a snapshot of a diversified portfolio with a variety of tech classes. What we're really trying to add to that from an institutional side is look at things where we may add in alternative investments, a longer-term philosophy with an emphasis given to some non-correlated investments, which will overall help the risk profile of a portfolio, but also drive long-term performance. So we have dedicated investment experts whose day in and day out job is asset management on our team. They spent their careers managing assets, and that is what their sole focus is. We use a strategic asset allocation methodology, but we also are opportunistic when we see certain securities that we feel needed to be added in, whether it be through a certain economic cycle that we're experiencing, that we want to be very tactical as well to add that extra value. As mentioned before, we have the support of the entire financial consulting team, working with us to achieve the same end goals for our clients. So tax, insurance, estate planning, asset protection issues can be addressed in a very coordinated manner where the thread is running through our process between each of the professionals, and ultimately we'll achieve the goals of our clients. So let's get into some of the portfolio rules and performance. So portfolio rules, and I know this can be a little bit of sometimes too much detail, so I really want to make this as easy as possible. But relative strength is really the most adaptive tool we have found to assist in discerning the strongest trends versus the weakest. So as advisors, we also create a whole portfolio of just strictly fundamental analysis, and then we marry those two between technical and fundamental. But the way that we do that is by looking at the relative strength in the market. So what this is going to do for us is let us be responsible enough to the changing currents in the market to cause some rotation in the portfolio. So in short, as it states here, relative strength seeks to keep losses small, yet permits the profits to run and create an overall successful portfolio. So at its most core level here, the portfolio is a rules-based systematic approach. So we're removing that emotional or human element for a portion of a client's portfolio. It may be 50% of your portfolio. It may be 30% of your portfolio. That's something we'll talk with each individual client about their overall level of risk and comfort with how we manage assets and which makes the most sense for them to reach their ultimate goal. So we're going to stay 100% invested at all times in this strategy, meaning in particular, this strategy that we use is for U.S. equity, the U.S. stock market. So for an example of a typical client who may have 50% in the U.S. market, that 50% we will stay 100% invested at all times. We're going to use ETFs, exchange traded funds, in order to gain access to the sectors that we're going to monitor for relative strength. So essentially, the reason we're using exchange traded funds over open-ended mutual funds or individual stocks is really more of a factor of lower cost, transparency, more of a tax-friendly environment. As you may or may not know, many open-ended mutual funds can pass on capital gains to individual clients when the individual client may have not sold that particular mutual fund to create that event, but that can be passed on. We avoid that with exchange traded funds. As I mentioned, you also get a lower cost structure, which is a big belief of our firm, to keep investment expenses as low as possible, which is in turn going to allow performance to be at its greatest. So we know that exchange traded funds are going to be the vehicle that we use in order to gain access to the varying sectors that we're going to rate relative strength on. So an important component of the portfolio here is we're really going to have only the top 5 sectors are bought and sold when they fall sufficiently out of favor versus the other potential sectors. So this is a very key component to how we keep turnover low in the portfolio and actually drive performance. I often get the question, if we're evaluating on a weekly basis the relative strength of these sectors, Bob, if the 5th ranked sector moves to the 6th, but then the following week it's the 5th, and then it's the 7th and the 5th, that seems like we could create a lot of turnover in the portfolio. So we want to avoid that. So in order to do that, our rules-based approach here is simple, that in order to actually be removed from our top 5 or our holdings, you actually have to fall out of the top 10. So this can create an environment where occasionally a position that is in the top 5 is actually not in a client portfolio because something has not dropped out of the top 10. Long term, the low turnover and the overall performance of maintaining positions for a little bit longer than we would if we were to simply flop 5 and 6 back and forth is actually outperformed. So it's something that is important to what we do, and it helps keep turnover low. But it's important to mention as we talk about the rules. As I mentioned, new sectors only add it when one falls out. So as we go, if we're going to have five sectors of the U.S. market in a client's portfolio, that we're only going to add in a position. We're not going to add in a 6. We're only going to add one more in if something does fall out of there. So obviously when that change is made, the portfolio is rebalanced, so each position is equally weighted. So if we've got some areas where, for example, biotech right now has performed very, very well for our client, if it has grown to the point where it actually is making up more than 1/5 of that allocation, when there is a change made, we'll go ahead and rebalance all of those positions to make sure that we're back to where we want to be. So let's just have a quick refresher again from our previous webinar on the relative strength, the actual calculation, the mechanics behind it. So the easiest analogy that I can give that I think makes the most sense is looking at some sports rankings. Look at the world golf rankings or the college football BCS rankings. What they're doing is they're trying to eliminate the human error or that human element, subjectivity, when we're looking at things that are out of control of either that golfer or that football team. We're trying to do that same thing here with sectors. So if you look at the world golf rankings, there's a lot of variables that go into the calculation to tell us whether Tiger Woods is the number one ranked golfer or Phil Mickelson is the number two ranked golfer. It can be everything from earnings of that golf tournament, how many wins they have. Some golf tournaments are weighted high, stronger than others. Same can be said for football rankings, whether it be strength of schedule or opponent and who that opponent were to beat. So we're really trying to take that same formula, those same calculations, to rank the relative strength of a sector of the U.S. market against other sectors and the S&P. So what this does for us as we plot these on these point and figure charts, it allows us to see a ranking system and see over time who is moving in the right direction and where do we need to eliminate. And so we were able to take a universe of sectors and come up with simply 5 for our clients and remove a lot of that emotion. So if you think back to, as we look at statistics here on portfolio turnover, if we think back to 2008, 2009, and we were in the credit crisis, the fall of 2008 into 2009, not that we had any more foresight than any other firm on Wall Street and were able to see the depths of the credit crisis and remove some of the scary things from our clients' portfolio, but more from a strictly technical standpoint. We were able to quickly eliminate the financial, banking, and brokerage and real estate pieces of our exposure because they very quickly broke through out of our top 10. And so while we did not limit all of the downside, we certainly eliminated quite a bit. So we've been using this portfolio since the fourth quarter of 2009. And as you can see here, so the numbers that you see prior to that are back-tested turnover numbers as we look here. So portfolio turnover, which is a very important aspect for our high net worth clients to manage their tax exposure, is as I mentioned before, how we want to keep portfolio turnover low. And so you can see an average of about 3.73, but even since 2009 with the actual numbers and not back-tested numbers, you can see we've had very little change even in the last 2 years. One change all of this year and one last year in the portfolio. The reason for that is when the market's doing well and there's some leadership there, you're going to find that we're going to let those winners run and there's just not a lot of opportunity for turnover. So in a typical portfolio, you're going to see quite a bit more turnover than this. So we're pretty proud of the fact that we're able to portion of your portfolio keep those trades at a very low number. So as we look at performance and some returns since that fourth quarter of 2009, just kind of want to make mention here of a few things. We've got the S&P 500 here in the middle column and the First Trust ETFs, which is what we use here for our models in the far left column, and then you can see the excess returns of that. So as we go along here, you'll notice there'll be periods of time where we're going to see significant outperformance from what we do for this portion of the account, and then we've had a period where it has pulled back less than the S&P. So let me kind of go through and explain when this part of your portfolio is going to really do well, and then where we need to try to gain some returns from some other areas. So as you can see, in 2010, portfolio did very well, just shy of 27%. The market was shy of 13%. 2011, we had underperformance of around 8% to a flat market. And then you see just slight outperformance in 2012. And then so far this year, we're having fantastic success in the portfolio with some significant outperformance. So down at the very bottom, you'll see the excess return that we've been able to generate of about 26%. Not that that's something that's going to happen all the time. And keep in mind, both of the S&P and the ETFs are without dividends, so that way we can make both of the numbers the most accurate. As we're looking at this, if we look at 2011 where we have some underperformance. So where this strategy will underperform a little bit is where there is a change of leadership a lot. So weekly, every 2 weeks, and there's really no significant leadership in the market between sectors. This portfolio is just going to kind of muddle around, or this piece of your portfolio. So what we've done is to make sure that we're still doing very well for our clients during those periods of time. We can weight the percentage of this portfolio to a lower percentage and start adding in things like alternative investments, precious metals, hedge strategies, maybe more fixed income if it dictates such, emerging markets, international, to give a more well-rounded structure to the portfolio. Where we have environments like we have now and what you saw in 2010 and 12 and now into 2013, where there is clear leadership of what is driving the S&P 500, you can see the reason it's performed so well is we're able to parse out that top five, that percentage of the portfolio that's going to do very, very well. So again, it's not something we do just strictly for performance alone, because I think it reduces the overall risk of a portfolio as well, as I mentioned, that 2008, 2009, and being able to eliminate very quickly. But clearly, it's a nice benefit as we go through. So how can OJM help? As I mentioned previously, we have a variety of team of experts here focused on everything from tax planning, retirement, insurance, and asset protection. Our team here of investment professionals that we can talk to a variety of things with you and keep an eye on taxes as we go forward, which is an element to what we do. So next steps, we would love for you to request a free copy of Four Doctors Only or Wealth Secrets of the Affluent. We can get those sent your way. You can obviously download as well from the link that can be found below this window. I would love for you to schedule a complimentary consultation or just reach out to our firm or myself. You see my contact information below. I'd be happy to answer any deeper questions on the two webinars that I gave on the strategy talk, answer questions, how it would apply to you, whether it makes sense, if it's something that you would want to do. So I think that's an area where I enjoy talking to clients and would be happy to educate you and talk in greater detail about that. So obviously you can also subscribe to our free e-newsletter and contact us in a multitude of ways. So thank you very much for your time today, and look forward to hearing from you very soon. Thank you very much for your time today, and look forward